Welcome to RBC's Markets in Motion podcast, recorded April 22nd, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, earnings sentiment is at an important crossroads, with the rate of upward EPS estimate revisions having fallen to 30%. Second, what we read in S&P 500 earnings call transcripts last week keeps us in the camp that recession is not a foregone conclusion, makes us concerned that any adverse impacts from tariffs may be felt a little later in the year or even next year, and pushes us towards the idea that the consumer is holding up but still hasn't been unscathed. And third, the idea that investors are rotating out of U.S. assets into other geographies is supported by recent funds flow data. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number one. Earnings sentiment is at an important crossroads. We're entering the busiest stretch of S&P 500 earnings releases for calendar 1Q25, with 290 companies currently scheduled to report in the remainder of this week and next week. The process of resetting earnings forecasts has gotten underway, a necessary step in the bottoming process for stocks. One of the ways we track this quantitatively is by watching the bottom-up consensus 2025 EPS forecast for the S&P 500. That stat, which had been sitting comfortably above 270 for most of calendar 1Q, did continue to fall over the past week and is now down to 265. We expect this number to go lower. Our own top-down estimate, which bakes in a stagflationary economy and margin contraction, is 258. But it's worth noting that important progress continues to be made here. We also like to keep tabs on earnings sentiment, particularly in periods of stock market stress, by tracking the rate of upward EPS estimate revisions to consensus estimates for the S&P 500. This is another bottom-up gauge, and in our opinion, it's at an important crossroads. After hovering in the low 40 to 50% range for most of calendar 1Q, this indicator has now fallen to 36% on the 4-week average. On a weekly unadjusted basis, this stat came in at 30% last week. Typically, for earnings to be de-risked, we need to see this stat get to around 30% in a non-crisis backdrop and 10 to 20% in a more dire scenario. If this indicator breaks below 30, we think it's reasonable to expect it to head toward that 10 to 20% range, which could put more pressure on stock prices short term. One small piece of good news, the stronger U.S. dollar had been a major headwind to S&P EPS revision trends, but recent dollar weakness should mitigate that issue. Moving on to takeaway number two. What we read last week didn't settle any key debates. As our regular readers are well aware, we spend a lot of time during reporting season reading through earnings call transcripts, looking for macro insights. What we read last week, which was limited to S&P 500 earnings calls, generally kept us in the camp that recession is not a foregone conclusion, makes us concerned any adverse impacts from tariffs may be felt a little later in the year or even next year, and pushes us towards the idea that the consumer is holding up but hasn't been unscathed. Reporting season was heavily biased towards financial companies last week, who seemed to make a concerted effort to provide context for how investors should be thinking about the economy. Not surprisingly, macro discussions were intertwined with tariff discussions. Several major banks noted they're anticipating slower economic growth, and that while they're not anticipating a recession for now, the odds of one have increased materially. Several companies highlighted how the tariffs announced on April 2nd were much larger than they or their clients had anticipated, how their clients were concerned about near-term and longer-term uncertainty emanating from this policy approach as well. Several companies alluded to the idea that the ultimate impact of tariffs is unknown and conditions were strong heading into this situation. Outside of the banks, we took note of how a few companies indicated they'd seen less of a spring surge. The banks that reported last week, along with some of the non-financial companies, also made an effort to lay out how they thought the business sentiment and/or financial markets were being impacted by tariffs. Several highlighted the recent uptick in volatility and how they expected that to continue. A pause in investment, CapEx, M&A, and decision-making in general were highlighted, though some also emphasized strong pipelines and the potential for a snapback. One bank noted that layoffs were simply not coming up in their many conversations with clients, though the needs to raise prices and protect margins were apparent. For the most part, the banks that reported described consumer spending as healthy, stable, and in good shape. One bank jumped out with their comment that there is still a lot of liquidity among high net worth customers, but that they might have seen the early signal of the impact of equity market declines. They didn't really elaborate on what they meant by that. Another bank also jumped out for noting that they had seen weather impact early in the year, which had stabilized by late March. On tariffs, the financials that reported noted that impacts were indirect. Several said they have been working with their customers to help them navigate the issue and understand exposures. Some companies reported that their customers were managing through tariffs with pricing, supply chain adjustments, pre-ordering, and scenario planning. A few observed that tariff impacts were more likely to be felt in the second half of 2025 or 2026, while one suggested that small businesses might be more adversely impacted. Outside of tariffs, policy discussions highlighted the benefits of potential tax policy changes and deregulation, the stresses of DOGE and USAID cuts and other government spending cuts that had been seen, along with the need to follow what was going on with the immigration situation. Wrapping up quickly with takeaway number 3, the geographical rotation and flows. We did spend some time on Monday reviewing the latest weekly funds flow updates from EPFR. Frankly, we lost count of how many of the charts we track were showing outflows. Most notably, EPFR's data has shown outflows in recent weeks for both U.S. equities and U.S. bond funds, including high yield and investment grade, as well as money market funds. The geographical rotation does appear to be back on, with equity flows to Western Europe, Germany, France, and UK, all turning positive again and/or improving in the last updates. Flows to other non-U.S. geographies have been choppy, but generally showing signs of improvement or positive flows as well. For now, the shift away from the U.S. has some clear evidence in the funds flow data. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any question.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.